Welcome back to Real Talk with Brian and Dan on 1150 KKNW.
I'm Brian.
And I'm Dan, and our first guest today is Mike Markert with Mike Markert CPA. Mike provides personalized service and guidance in a wide range of financial and business needs, including tax management, CFO services, accounting, computer consulting, and financial planning related areas. His client base consists of privately held businesses and their owners, independent professionals, trusts, and individuals. Welcome to the show, Mike.
Thanks a lot, Dan. Thanks for having me.
No, I appreciate you coming on. We had a lot of questions, about CPAs. Brian and I get them all the time, so we've got a bunch of questions for you. But before we get into that, what are some of your hobbies and interests? What do you do when you're not crunching numbers or counting beans?
You're not CPAing.
Well, I'm writing my golf score on I love the golf.
Okay.
Yeah, trying to lower my
handicap. You said writing your score, so that must mean you.
Well, I always carry an eraser when I'm
sure
golfing.
You do. Sure you do.
Yeah. Anyway, I like to golf and travel internationally and wine taste with friends.
Wine taste with friends. Yes, I've tasted wine with you before. Delicious.
Yeah. Where do you like to wine taste? What's your favorite region?
I don't have a region. We belong to a number of wine companies.
Clubs.
Janik is a favorite. I'll put a plug in there. And JM Cellars.
Nice.
They're very good. So the Walla Walla, there's no bad wines in Walla Walla.
Yeah. So I'd like to ask each guest to share with us a fond memory of the home that you grew up in.
Ooh, so I grew up in Moorhead, Minnesota, across the river from Fargo, North Dakota. Remember the movie Fargo?
Oh, unfortunately,
the wood chipper, right?
Yeah.
Yeah. Okay, we all remember that. Yeah. So a vivid memory of mine is in a winter storm, like 40 below, and we had single pane windows, and I could actually see the single pane window, vibrate back and forth in the storm. Anyway, I just remember it just popped on by. That's a negative memory. A positive memory in the neighborhood. We had an empty lot down the street, and all the guys and some of the gals, we'd go over there and we'd make a ball field out of it.
Play baseball.
We'd cut,
Nice.
We'd cut the grass, and just like Iowa.
Oh, that's
If
good.
they
Old
build
days.
it.
They will come.
Yeah.
That's awesome. Well, so we have, we kind of put this out there. We're going to have this tax expert CPA on the show, and so we put out some feelers, and so we got some really good questions for you. Okay, so I hope you got your what is it, that visor on?
Yeah,
right?
I got it. It's green.
It's green
visor.
He does have a green visor. That's no joke. So when considering, there's a lot of liability. So let's say I've sold my primary residence. Do I have to pay capital gains?
Well, it depends. That's what I always start out with clients. It always depends. So if you sell your personal residence and you live in it 2 out of the last 5 years, you may be eligible for up to a $500,000 capital gain exemption. So basically, it breaks down to the selling price less the selling costs. You got to pay the commissions of the real estate guy.
Yep.
And of course, the excise tax of the state of Washington. All right.
Yep.
Then you subtract your tax basis. And then you subtract the capital gain exemption. And what's left is either a gain or a loss. And if it is a gain, you have to pay taxes on it. Uncle Sam wants the money. But if it's a loss, it is a loss, and you're not able to claim it on your tax return.
Uncle Sam pays you back?
Oh, no.
No.
We have to talk to our congressman about that.
Yeah, we get a rebate, right?
Yeah.
So you pay at the capital gains rate, though. Is that correct?
you pay at the capital gains rate, 15%. If your taxable income is less than $400,000, if it's more than $400,000 filing married jointly, you're at a 24% rate.
Gotcha. Okay. So questions from our fan base. I sold my vacation home. Do I have a taxable capital gain?
It depends.
Depends. I knew that.
Good answer. Yeah. So give us some of the variables.
Okay. So when you sell your vacation home, yes, you will have a capital gain if you go through the equation I just discussed earlier: sell price, less the selling costs, less the tax basis, and if there is a gain, you pay tax on it. There is no capital gain exemption with a vacation home or a second home.
Now, if that were used as an income property at some level, would there be tax implications for that?
There would.
So many people doing the Airbnb and such, if they put it into rental service.
So that's a different gig.
Yeah,
because that's a hybrid, right? It's a vacation home.
It's a hybrid, and that really depends. So sometimes you can claim depreciation against it. I would. It all depends upon the circumstances whether we would claim depreciation on it, I guess.
So I guess it depends.
It depends.
Yeah, it depends.
Yeah. There you go. Standard answer. Boxers
Okay.
or briefs? Depends.
I had a joke in that there too. All right. So here's a question from one of our listeners. The home I inherited from my parents, we're going to sell. Will I have a taxable gain?
It depends.
Oh, we thought that might be the case.
Yeah. So anyway, some of the circumstances that you go through when you inherit a property, the most important thing is you need to have a real estate valuation, and it's based on the date of the individual's passing. Okay.
So who may do that valuation?
You could have a real estate agent do a real estate comp for you.
Okay.
Yep.
Okay, and that's acceptable. Or you could hire somebody and do an actual
Sure.
valuation.
That's my real
Appraisal.
question is can people turn to us to help them with that? As licensed real estate brokers.
Yes.
They can. Good.
Yep. You bet. Yeah.
Well, there you go. Something we can do.
So if you inherit a property, you get the valuation, and typically, if you hang on to it for 3 or 4 years, then once again it's a selling price less the valuation, and you may have a gain or a loss.
Okay. So the value of the property at the time of death, does the basis adjust to that, or is that something different?
No, the tax basis of the property is the basis at her passing, or
Okay.
at his passing. Yes,
Okay. So that's a little different than if they were to sell it before passing away.
correct. Yeah.
Okay. So I have a rental property, but my CPA says I am unable to claim the rental loss. Why is that?
Oh, gee, and I run into this.
It depends.
Yeah, it depends. So I get a new client coming on board, and they just bought this rental property, and it's a loss, and the previous year they were able to claim the loss, but all of a sudden Amazon hired them, and their income is over the $150,000 threshold. So they're unable to deduct a rental property loss if their gross income is over the $150,000 threshold.
Okay. All right. Very complicated stuff here. Okay. Here's one that's kind of a hybrid of a previous question. It said, I'm selling my principal residence and would like to roll the gain or avoid paying the capital gains taxes by rolling it into my new principal residence. How can I do that?
I get that question a number of times. People are, they're really being creative when they're trying to reduce taxes or escape
Well,
taxes.
wasn't there, before the present law, wasn't there a deal where you could roll into your new home? Wasn't that the prior
That
before
was
500,000?
a good question. That law changed, I think, in 2006. The way that law read was if you sold your home principal residence,
Right.
and you had a gain, and you purchased a new principal residence within a 2-year period, you wouldn't have to pay capital gains on it.
Right.
Well, that went away in 07 or 08.
Oh, wow.
Yeah.
The new law being if you lived in the house 2 years out of the last 5 before you sell it, then you could claim the capital gain exemption.
I think people still think in terms of that old law, partially because real estate transactions are, typically,
Stepping stones.
5 to 7, 10 years apart. So they're still in that mindset sometimes.
Yeah,
So,
that's a good question. And nowadays we have a number of mature clients that have been in the home for 30 or 40 years, and they're selling their home, and they don't know what the new tax law is, and they
Right.
bring that up. Well, if I buy a new home within that 2-year period, can I escape paying capital gain taxes? Nope, the laws changed.
No.
Yep.
So basically, you still have to pay capital gains. You can't roll it into your future home.
Yeah, you can't roll it
But
into
you've
future
got
bill.
up to that $500,000
Exemption.
That's
Ah.
kind of sweet.
But one other thing that does come up, and as a like-kind exchange, a couple of my
okay.
clients have
1031 exchange.
1031 exchange, and a personal residence does not qualify
Can't do
as
that,
a like-kind exchange.
So I'm gifting the down payment to my daughter and family to allow them to purchase a personal residence. Is the gift taxable?
No, it is not taxable. It's just reportable. So that's the good news.
That is good news.
Reportable.
Reportable
What's
to
the
the IRS if it's more than
Oh, I see.
$14,000 a year.
You have to report to the IRS, but they just say, okay, but not tax you on it.
Not taxable. And Grant may expand on that, or Grant's the guy to talk to if it is a large gift.
Okay.
Because it may become taxable later.
Yeah, which is why
Grant.
we kind of had these guys in together, because Grant will expound on some of this stuff a little later. So that's
Yeah.
awesome. Yeah, very good. Here's a question. The new home I purchased has a mortgage of $900,000. Is all the mortgage interest deductible?
It depends.
Oh my gosh.
Really? Well, that's a surprise.
So if the mortgage balance was $900,000 at the end of 2017, all the mortgage interest would be deductible in 2018 under the new tax laws.
Okay.
But if you purchased the home in 2018 and it had a mortgage value of $900,000, only $750,000 of the interest would be deductible, up to the $750,000.
So anything before December 31st, 2017, anything before that,
is fully deductible, up to $1 million.
$1 million.
Yeah.
Very good. Okay.
Okay.
And then it went to 750.
Then it went to 750.
Okay.
I see.
So what is the rule to be able to deduct a rental loss if your income doesn't qualify and you're not a real estate professional?
Ha.
I guess that's an active versus passive question.
Yeah, a little bit. Well, so if you're not a real estate professional, I go back to the previous question. If your gross income is over $150,000, then you're not going to be able to take that
Rental
loss
loss.
deduction.
Mm-hmm.
However, if you materially participate in the rental property, you can deduct the loss.
But what does materially participate? Like walk in the front door?
No. Make
it better?
You're in the daily decision process
Of renting.
Managing the
renting it
property.
and dealing with the property.
Okay.
So that's material participating.
That's kind of a good advantage for real estate agents.
It is, isn't it?
Yeah.
Yeah. Some of us use that.
Definitely. All right. What other questions do I have? We have a few minutes left. Okay, here's one. Do I have to file a state tax return for rental property outside of the state of Washington?
Yeah. Yes. There's no getting around it. In the state of Oregon, if you have a rental property in the state of Oregon or the state of Idaho or the state of California, you live in Washington, you have to file a state return. Whether
For a personal state return?
a personal
state
tax
income
return
tax
for the
return.
for the
State
state
income
of,
tax
state
return.
of Idaho and the state of Oregon. Yes, you
Yep.
do.
And
Ah.
California.
And
I've got
California.
rentals there, and guess what? There it is.
That's interesting.
So when someone passes away, what are steps to take to secure proper taxation going forward?
Well, the first step is the valuation of the assets. Now we talked about
Right.
that earlier. Typically the most valuable asset of somebody passing away is their house, their personal residence.
Mm-hmm.
So you should get a valuation on that as soon as possible, so that you get a stepped up basis, which is what we talked about before, to the valuation of the date of death. So and if there are stocks involved, the broker would be able to handle that and take a stepped up basis to the date of death.
That
very
stepped up
easily.
basis is a big deal.
It is a big
Because
deal.
especially in this market with the high appreciation we've had. That is huge.
Yeah.
Yeah.
And one reason why, I've discussed this in tax planning with a number of clients. So a client wants to gift some property assets, typically a house or rental house, before she passes away.
Mm-hmm.
Well, if that happens, then
Yep.
the sibling will get the basis of the owner of the
Right.
donor,
Right.
and
So
and they won't get the basis. They won't get the advantage of the stepped up basis.
So the advantage there is just to put a will in place, right?
Put a
that
will in
basically
place.
does it after death. That way they take advantage of the positive outcome there with regards to the basis adjustment.
Yes.
So to make this crystal clear for our listeners, or at least I hope so, I had a recent transaction, Bellevue. The parents paid $37,000 and waited till they passed. The new basis was $750,000. So if I'm understanding this correctly, if they had deeded the property to the family, to the kids, at the 37 value, they would owe taxes on the difference, the 37 versus the 750, versus waiting till after they pass. So there's no capital gains or little.
Very little.
Is that
Correct, if I understood. So if they took possession of the property after they passed,
right?
the tax basis would be $750,000.
So that would virtually eliminate that capital gain versus
Yes.
deeding it to them.
Well, yes and no. It depends.
Okay, I'm not surprised.
And this, you guys know the market.
Yeah.
So
Right.
let's say that house, they hold on to it for, let's say 1 year, and they sell it. They sell it for $1 million.
Right.
Oh,
Okay.
sure.
Yeah.
So
They're
then
going
you
to
got
pay
a potential
between the 750.
Well, this
Yes.
situation, they
$250,000 potential capital gain.
took possession of the home and immediately turned around and sold it. And so
there
that
probably
established-
no capital gain.
Yeah.
Well,
right.
Mike, we have many, many more questions. And here's what I love about this conversation, and I hope our listeners get an opportunity. If you have any questions, Mike is somebody that I've known for many years, 8, 9, 10 years, I think.
Yeah.
And I've always gotten great feedback from anybody I referred him to. He does my own taxes. He does my corporate taxes. And very insightful, right? I mean, to be able to have these questions and we're rapid firing and you boom, right there. So that's about all the time we have for that segment. But thank you for coming in, Mike.
Thank you very much, Dan and Brian.
After the break, we have in studio Grant Monson with Altera Advisors, who will be discussing how your wealth matters.